and welcome to another episode of Open Banking Expo TV in association with Experian. I'm Ellie Duncan, Head of Content here at Open Banking Expo, and today I'm joined by Experian's Chief Economist and Director of Market Intelligence, Mohammed Chaudhri, and Natalie Hammond, Head of Product and Proposition Marketing at Experian, for this episode, which is titled Navigating the Cost of Living Crunch. Now, I'm going to be drawing on Experian's economic expertise and credit data insight to unpack the current cost of living crisis and what it means for lenders and borrowers. Before we get going, I'd just like to remind you all watching at home that the entries for this year's Open Banking Expo Awards are now open, and you have until the 1st of April to enter. More details can be found on the openbankingexpo.com website, and best of luck. Now, let's get underway with our questions, and I'm going to come to you first, Mohammed, because there's been plenty of press coverage about this cost of living crisis that we're currently living through. But for some households or for certain demographics, it might not really feel as though anything has changed. And in fact, they might feel that their standard of living has remained largely the same. It does appear that the crisis will start to be felt a bit more acutely now. Obviously, there's several reasons behind that. So what's changed that means this cost of living crisis is coming to a kind of crunch point?
Thank you very much, Ellie, and good afternoon, everybody. So in today's session, we're going to go through the main themes around the cost of living. And Ellie, as you've pointed out there, this isn't something that's brand new in terms of for this month or for the last 6 weeks. In fact, at Experian, we've been calling out the challenges associated around the impending increase in energy prices, which is just around the corner in April, for nearly 6 months now. What we've seen over the last 6 months is gas prices continue to reach new record highs, hand in hand with other energy prices, which continue their upward march. Now, the question, as you articulated it there, is all about when are households going to start to feel that crunch? And whilst it may be true for some households who have not seen the cost of their living, maybe the cost of their weekly shop or even the cost of their energy prices going up just yet, unfortunately for many households, they are already living with the day-to-day impacts of higher prices. So if we unpack that, which types of households potentially haven't had the increases in the cost of living come through yet? Well, those households are going to typically be more affluent. They're going to be towards the right-hand side of any income distribution. But even for those households, many of us, and myself included, got a letter from my energy provider just earlier this month in terms of a nearly £150 increase in my monthly bill that's going to be coming out. Now, maybe that's the reason, because those bills are going up from April. So we've all known about this. Ofgem announced the fact that there was going to be this near 54% increase in the price cap. And so for some households, typically the more affluent households, the cost of living hasn't crunched yet, if you will, but that crunch is coming, and it's just going to be here in a couple of months. Turning our attention back to other demographics that you mentioned there, most definitely there are certain parts of our population that are living with the day-to-day impacts. And I'll get into this in a little bit more detail, I'm sure, as we kick off the discussion with Nat and yourself. But if we look at the average inflation rate, why are we talking about this today? The average inflation rate is at 5.5%. That's the highest it's been in nearly 30 years. But the word average hides a multitude of details underneath it. And for some households, the cost of living crunch, it's not a 5% increase. You can double that or even triple that. And so some households are already living with the day-to-day impacts of price increases. Some households are waiting for that to come through. What can be guaranteed, unfortunately, is we will all feel the impact of increased prices over the next 12 months.
Thanks, Mo. You've painted a picture there of the economic situation and the economic sort of backdrop. Like you, I also received a letter from my energy supplier saying how much my bills are going up up by from April. So it does, in fact, seem very real now, this cost of living crisis, as you pointed out. But yeah, there's a lot of figures that you pulled on there, but let's talk about the impact in kind of real terms on households. So can you explain a bit more about that, and which households are kind of most at risk at the moment?
Yeah, absolutely. So as we start to dive a little bit deeper beyond my initial opening remarks, what we can start to tell a story of is a decline in income. And I'll use the word real income because that in reality is what we're talking about. People's wages are going to go up this year. We've all lived through the last 2 years where the pandemic had a real dampening impact on overall economic activity. In fact, many households saw savings increase from where they were pre-pandemic. And as we entered into 2022, many households still were yet to spend those savings. So when we look at the financial impact, the pounds terms of impact, if you will, those impacts are going to be once again concentrated in those lower demographics. So if we were to talk about income deciles and talk about the overall UK population, we'll split them into 10 evenly spaced and evenly numbered pots of population in order to get to those deciles. And if I was to say to you, the lower two parts of that distribution are where we're going to see the biggest impact. Now, I spoke about the average inflation rate. Typically for those households in those lower two deciles, you will be looking closer to a 15% increase in the cost of living. Many of us on the call today may have been aware of the excellent work done by the campaigner Jack Monroe, who has continued with should we say, pressure on the ONS, the official Office of National Statistics in the UK, who are in charge of publishing cost of living figures, to move away from the average. Because like we've mentioned, Ellie, you and I, potentially the cost of living crunch is coming, yet that inflation is 5.5%. We expect it to reach nearly 8% within Experian forecasts. The pounds terms are now starting to add up for those lower demographics. We are expecting at least a 500 odd pound increase in energy. We are expecting the cost of food to go up with anywhere around £1,000, if you will, in a year. You roll onto that, for some of those people on those lower incomes, they have also suffered an income shock. Let's not talk about what's happening on the expenditure. Let's talk about what's happening on their incomings, their income. And for some of those, they are seeing a £1,040 impact from universal credit. So even before we start looking at the outgoings going up, what's coming into their bank and their bank balance is also going down. So for me to draw the answer to a conclusion, it is those lower demographics, but I'm sure we'll get into this as well. This isn't just a cost of living crisis, which is just about the lower paid, the lower income. No, this is a cost of living crisis which goes across the deciles. As we move in middle income brackets, what we'll be finding is those middle income groups are also going to be disproportionately hit by national insurance and the freezing of tax thresholds. So what we will be seeing is the fact that whilst they may not spend as much of their expenditure on energy and food goods, which are very, very sensitive to inflation, they will be paying more, and in some cases up to £1,500 more on their national insurance contributions. At the very same time, tax thresholds have been frozen. So for those of us who are familiar with how the taxation system in this country works, we have a personal allowance, we have tax bands at which we start paying higher levels of income tax. Those are regularly updated by the government on a year-on-year basis. They are frozen this year. So all else being equal, each and every one of us will be poorer at the end of 2022 than when 22 began. And look, that's a provocation, maybe something we can go into more detail and go backwards and forwards with us and look at how Experian are actually trying to bring that a solution into the marketplace to try and address that. But it's a provocation which is backed up by the statistics. The Bank of England themselves are forecasting the greatest drop in real incomes on record.
Thanks, Mohammed. It's fair to say you've painted a rather grim picture there, and some of those figures are obviously going to seem quite scary to people. But I want to come to you now, Natalie, because um, as I've just pointed out, Mohammed has talked a lot about the risks. You obviously have all of these data points that you gather at Experian. So can you tell me kind of how you use those and to help lenders ultimately, because they're the ones that have to kind of strike that balance, don't they, between taking the opportunity to grow, but also being cognizant of this rising risk environment?
Yeah, thanks, Ellie. I think, like we've heard, there's a lot of risk, but also there's a lot of opportunity. So the whole environment is kind of almost two ends of the spectrum. How do I grow, but how do I mitigate risk, and more importantly, protect consumers? And Mo spoke about it a lot. And previously, it was more around kind of the law of averages. So what does the average data say, and therefore, what does the future outlook look like based on those averages? But you can almost look at it now and think, actually, it's more about the law of sciences, the need to be able to assess, model, test as a continual basis to bring in those additional data points that are going to be able to give different analysis and different scenarios based on the different factors that are facing. And I think what's really interesting is it is obviously a trying time from an economic perspective. If we look back over the last few years, there's been different points in the environment where the economy has placed strain, whether that was Brexit previously, the pandemic that we spoke about, or even further back, interest rates rising at a much faster rate. And it all comes back to the need to be able to understand where the risk is. And I think one of the really important things today is, like Mo said, there's different data points that you can bring in to be able to get that analysis. And you can take that from the macroeconomic level, the regional level, you can look at the households, but taking it down to the customer level to look at the implications that these mean on those, on their affordability and on their stress is going to be even more important to be able to not only understand really granular forecasts around risk and looking at capital, but also being able to look at what treatments are needed, what groups need what. And it all comes down to the additional data. And as I said, there's multiple forms of that, the economic data, bureau data, all of that coming together, lenders' own data to be able to really understand. And then you almost get into the point of monitoring as well. It's not one thing's going to happen and then that's happened. It's constantly happening, constantly evolving. So understanding that change and the implications of change and being able to bring in new characteristics as well. So just coming back to a point that Mo said, previously the rate of unemployment has been a really good indicator and predictor of stress. Today it's about those real incomes. There's also that real strong correlation between sector trends, regional trends, etc. So therefore the requirement is to be able to better understand different assessments, different data to be able to model against them and what that actually means.
Yeah, Mo said earlier about the fact that, we have seen this cost of living crisis coming. For example, we've known that from April, energy bills will go up. So, Natalie, does that mean Experian has been able to kind of account for all of that and build it into its solutions kind of well ahead of time, as it were?
Absolutely. One of the things that we do at Experian and pride ourselves on, and Mo and the team have won many awards because of it, is that forward-looking view, being able to look back and take that real granular view back, but also forward based on the next couple of weeks or months or up to 5 years. So bringing that all together, what we're able to do is we're able to provide the scenarios that give an assessment, almost a RAG rating. Where in your portfolio is that stress and where will that stress be? But then on the flip side, coming back to not missing the fact that there is opportunity and there's huge opportunity to grow as well. Actually, you can look at what are the opportunities for me? Where can I grow new business? What new products can I launch into market? Where are them segments? Where are those audiences? And bring that together, all of the different data together to really be able to understand it. But most importantly, it's as a managed service that can be given to our clients so that they can overlay that onto their portfolio to be able to really help them to understand both opportunity and risk at the same time. So we can provide that, and we're actively doing that in the market in different ways based on the requirements. But ultimately, it's that forward level view a real granular understanding based on the different characteristics. So I think one of the real key things is it's more often than not the lower income, lower affluent who are impacted. But as Mo said, lots of different people will be impacted in different ways. But what does that impact mean? And that's what's most important.
And Mo, I just wanted to come back to you because I'm wondering, well, really find out from both of you, but Mo, initially, have you started to see a change in sort of borrowing trends based on the fact that actually we're seeing this kind of crunch point kind of coming around now? So, for example, are borrowers making different lending decisions from, say, a year ago or even 6 months ago?
No, excellent question, Ellie. And what I'd like to do is kind of bootstrap this answer into the market that we're facing today. So we're talking about cost of living. We're talking about an affordability challenge primarily for a lot of borrowers at the moment who are going to be taking on debts in an uncertain environment, in an environment where when they are taking those debts on today, their expenditure is different to what they will be in 6 months, 12 months, whatever the term of that borrowing, we can guarantee that their expenditure over that term is going to go up. And we'll get into that in a moment. What kind of behaviors will that drive? What kind of borrowing behaviors? What should lenders be looking for? How do lenders actually make sure that they continue to make decisions that are fair and they're able to identify those vulnerable customers? But at the very same time, I mentioned at the end of my question and answer a while back, interest rates. At the very same time as cost of living is going up, we are seeing the Bank of England increase interest rates from record lows during the pandemic to already 0.5. So we've seen 2 hikes, one in December, one in February. Now, many expectations and our own are suggesting that we're in line for at least 1, if not 2 hikes. So by the end of this year, we'll be looking at interest rates potentially closer to 1%. So what kind of behavior is that actually leading to? Well, according to the data that we have coming into us through the Bureau, and it's backed up by Bank of England data, we are seeing the mortgage market and many more people who are cognizant of the fact that interest rates are going up, looking to fix their borrowing. Now, at the start of the previous financial crisis, 2007, if you will, almost 80% of the population were on standard variable rate, or as another description, non-fixed secured products. So any kind of interest rate rise in that environment would have had a huge impact. Where we are today is that almost has reversed. Now, 4 in 5 of us have a fixed mortgage, which means the interest rate rises that we're talking about will only affect 1 in 5. Now, that's still a big population. So those 1 in 5 are starting to look to refix their mortgages or maybe fix their mortgages. Those of us who are rolling off our 2 and 5 year fixes, potentially looking to remortgage. So one set of behaviors that we're seeing in our latest data is that drive to remortgaging. That will help with making sure there is some certainty returned back to household finances. The other thing that we are seeing through the borrowing, and something that lenders themselves are monitoring closely, is this economic uncertainty. We are seeing prices going up. We are seeing petrol prices going up. If any of us are commuting at the moment, we would have seen rail fares go up by nearly 10%. Now, the reason I mention this is because this is what's going to be driving certain behaviors. How many of our consumers are going to be borrowing to, shall we say, flatten out their consumption cycle at a time of need? Can they access some borrowing in order to make ends meet? And we will also be seeing people who are borrowing in distress, people who are borrowing potentially in a situation where they know that they're not going to be able to keep up with their credit commitments. From an affordability perspective, how can we help identify? And as Nat's mentioned, I'm always guilty of focusing too much on the risks. It's part and parcel of being an economist. We are risk-averse beings. We talk about risk all day. It's the community that we all serve. At the very same time, the opportunities are out there. There are households who have saved during the pandemic, households who are no longer commuting in the new world, households who are actually more financially resilient than they were 2 years ago. if those households are looking to borrow, if those households are looking at other products that they can take forward, as you asked the question, what's their types of behavior? What are they going to be spending on? We all know that there's still a shortage in new cars, for example. When does that start to have an impact and start a dampening effect on the auto sector? So again, tying all of those strands together and into a very neat answer, we are seeing some behavior coming out. The behavior that we have seen in our data is an increase in people looking for refinance around their mortgages to provide that certainty. As we go into this year and throughout, there will be people looking to smooth out their consumption cycle, hopefully trying to turn to a line of credit in order to continue to consume. What we want to make sure is that we're able to identify vulnerable consumers who potentially are turning to us in a distressed borrowing state. And as a community, as an industry, how can we actually drive those outcomes to make sure that we continue to help our borrowers?
Yeah, I think you made some really, really good points there, of course. And Natalie, I wanted to bring you in at this point to kind of perhaps pick up on what Mohammed was just saying about the fact that obviously there will be borrowers who are kind of distressed, they're vulnerable. And actually, in certain situations, I suppose, it might actually not be appropriate to lend to those borrowers. So how have you kind of incorporated that into Experian solutions, and perhaps you could kind of elaborate a bit on that aspect of it all?
So I think, again, it comes down to the knowledge and the clarity and being able to really understand those behaviors, those attitudes, etc. as well. We've continued to invest in our data, in our analytics, in our models. And over the last 2 years, obviously, there's been a whole environment placed upon us that isn't one that we've seen before, that we've had previous learnings on. But what we have been able to do is learn really rapidly. So bringing out additional data, additional indicators and models of stress to be able to give further granularity, being able to kind of drill down into the different economic factors that we spoke about, but then also the investments that we're making in continually improving and augmenting our suite that we have today. So, for example, the ability through our affordability suite, whether that be bureau-based or whether that be through open banking. But then also on the other side, it's around that investment in our analytics and our platforms, where what we've been really focusing on is how we can democratize access to data and analytics to be able to empower clients to be able to understand this and model against it. So whether you're looking for kind of a templated and out-of-the-box solution that can provide you with insight, or the dynamic environment that's going to provide you with the ability to model and test. But that's been really crucial. We've continued to invest in these indicators, in additional data, etc., and models, but also the ability to be able to turn those models into something that is going to bring more value to the customer interaction and therefore the customer outcome. And that's been a real focus. We've heard for a long time around the opportunities presented by machine learning, by cloud, that decisions need to be driven off data. And absolutely today, through the investments, through our focus in regards to data quality, etc., we're able to really bring that together, but empower businesses of all sizes and all types based on understanding on their needs. And I think that's going to be continually key and something that we really, really invest in as an organization. What's the problem that needs to be solved, and what can we do to innovate to be able to help that? And we're seeing some real kind of innovations and outcomes, most importantly, outcomes come out of that. The ability to be able to optimize those lending decisions you're saying, increase credit limits or decrease credit limits, to be able to really understand the performance of scorecards, but test and learn in a safe environment as well, but then the ability to be able to deploy. What we then get to is the ability to really be able to keep pace, to really be able to drive against the requirements and based on the economy, based on the customer, and based on the environment that we're in today. So we move from it being quite a lengthy process to something that actually can give instant access to insight and MI that can then simultaneously be brought into the live environment. And that's where we're seeing, from the different things that we're doing across different areas, the real value. It's a case of turning those outputs into real outcomes, because of the abilities that are offered through that data, that analytics, and then the ability to be able to turn that into action.
Mm-hmm. Thanks, Natalie. And kind of finally, I guess one for you both to answer. So, Mohammed, I'll come back to you first. But as we pointed out, it is quite a grim economic picture, and there's been plenty of coverage already in the press. Sometimes it can be hard to know what to disregard and the kind of information that you actually need to take in and listen to. But at Experian, obviously, you do have this kind of wealth of data at your disposal. So is there anything in a way that you can say to kind of reassure those lenders, borrowers in the market who perhaps might be a bit concerned about the kind of current situation?
Absolutely, and I think the reassurance, the comfort that we can all draw as an industry is the experience of the last couple of years, and I'll benchmark that with the fact that the government's not at present providing as much support as it did during the pandemic. But there is this understanding and this real resilience that is there within the households who've lived through the last couple of years. So we've seen people make choices. What we could see over the next 12 months is people trading down potentially, so substituting higher expensive consumer goods for lower expensive goods, and we'll be looking towards the data to monitor that. The one thing that I would say, and that gives me comfort, is the way that we are all using data now. We have the granular data, we have the data that gives us the ability to really start to look at both from a customer management and decisioning perspective, being able to put in strategy rules, policy rules that are going to help our borrowers, help us in terms of our own provisioning against bad debts. The economic situation, and this was a provocation earlier when I said it, and it still holds true, is grim. It's grim at that macroeconomic level. It's grim at the demographic level for some. It's not so grim for others. So you can have a way of cutting into those other more positive demographics. That's a positive for a business as well. But at some point, we do expect inflation to start to wane. It's a statistic that in the last few weeks, it feels that the transitory shock that many economists had spoken about only 6 months ago has turned into a shock that will be there for 2 or 3 years. If we can use the data, update our models, and I guess back to Natalie's point, it's that continual monitoring, being able to keep on top of the latest risk, being able to know what's coming next. That gives me comfort, because forewarned is forearmed. And I definitely do believe that within the credit population today, we have a lot more people who are forward looking, who aren't just waiting for things to happen and show up in their data. They're forecasting forward, they're horizon scanning, they're looking for that next big risk. And I do think as an industry, we are much better now than we were a decade ago.
Thank you, Mohammed. And Natalie, any final words from you or anything you want to add to what Mohammed has just said there?
I think Mo has just summarised it really well, and actually the conversation has all come back to it. It's all about being forewarned and therefore forearmed. And actually, whilst we've had a lot of learning to do over the last couple of years, that learning has really accelerated us to a point where we're actually now at the point of really changing kind of how we do things and really being able to get much quicker at delivering them customer outcomes. And I think it's absolutely all about the data. We've spoken a lot about that today, but most importantly as well, it's about what you do with that data. It's about what that data is telling you. So it's around applying those analytics to be able to understand that and the patterns, which then gets you to the point of being forewarned and forearmed. And I think that's really interesting. And I think there's huge opportunities in both consumers and in businesses. And today, the data, the analytics, and the ability to be able to turn that really puts us in a completely different place. So hopefully, if there's one thing we've learned over the last couple of years, is that we can learn and respond really quickly, and the opportunity to do that is there. And I think that is a real game changer.
Thanks, Natalie. And look, it's obviously a really uncertain economic time, but it seems like the one thing we can rely on is the data. It's certainly our friend at the moment. So thank you both, Mohammed and Natalie, for speaking to me today and for giving us all your insights. And thank you to Experian more widely for helping to produce this episode of Open Banking Expo TV. There are plenty more episodes that you can find on the Open Banking Expo website via the on-demand section. But all it leaves me to say is thanks for watching and goodbye for now.